This transaction shows us how acquiring assets can affect our liabilities. We debit the equipment and credit accounts payable, which indicates we owe money for this purchase. Then we see the payment of $800 in the cash for our rent. Here we are reducing our cash and recognizing rent expense. This reflects the operational cost that every business must manage. Welcome everyone to our introduction to the Principles of Accounts or POA. Today we are going to explore how POA serves as a foundation for understanding accounting concepts, financial statements, and bookkeeping practices. The essence of POA lies in helping businesses effectively track their income, expenses, assets, and liabilities. This is crucial because with accurate records, businesses can make informed financial decisions. By mastering these principles, you will not only gain insights into the financial health of a business, but also enhance your ability to contribute to its success. Next, we'll delve deeper into some basic accounting concepts that are essential for anyone looking to navigate the world of finance. Okay, let's dive into some basic accounting concepts that are essential for understanding the principles of accounts. First, we have the accounting equation. Assets equal liabilities plus owner's equity. This equation is foundational because it shows that what a business owns, which is assets, is financed either by borrowing, which is liabilities, or by the owner's investment, which is equity. Next, consider the, consider the double entry principle. This principle states that every transaction affects two accounts. One is debited and the other is credited. It ensures that the accounting equation always stays balanced. Lastly, let's touch on the difference between accrual versus cash account. Accrual accounting records transactions when they occur, regardless of cash flow. In contrast, cash accounting only records transactions when cash is exchanged. This distinction is crucial for understanding how financial performance is reported. These concepts lay the groundwork for more complex accounting principles we'll explore next. The next one now is key accounting terms. Today, let's dive into some key accounting terms that are essential for understanding the principles of accounts. Firstly, we have assets. These are resources owned by a business, such as cash or inventory. Think of them as what the business possesses that can provide future economic benefits. Next, we have liabilities. This refers to amounts the business owes, like loans or accounts payable. It's crucial to know these as they represent obligations that the business needs to fulfill. Moving on, we have owner's equity. This is the owner's investment in the business reflecting the residual interest after liabilities are deducted from assets. Then there is revenue, which is the income generated from business activities. This is a vital term as it indicates the financial health and operational success of the business. Lastly, we have expenses. These are the costs incurred while running the business, affecting overall profitability. Understanding these terms is fundamental as they lay the groundwork for more complex accounting concepts we'll explore next. Now let's look at how we record these financial elements in the accounting books and records. Let's delve into the accounting books and records. First up, we have the journal. This is the initial record of all transactions. Think of it as the starting point where every financial event is documented. It's crucial because it sets the stage for all subsequent accounting activities. Next is a ledger. This is where we break down those transactions into individual accounts like the cash account or sales account. It's essential for tracking how each area of the business is performing over time. And lastly, we have the trial balance. This is a summary of all ledger balances and it's used to check for accuracy. If everything adds up, we can confidently move forward in our accounting process. These three tools are foundational in ensuring proper financial management. Um, how many of you have interacted with these concepts in your own businesses? As we move on, we'll explore the accounting cycle, which builds on these records. As we dive into the accounting cycle, let's break down the essential steps involved. First, we start with identifying transactions. This is where we determine what financial events occur within the business. Next, we record these transactions in the journal. Think of the journal as the initial logbook for all financial activities. Then we post to the ledger accounts. This means transferring the information from the journal to the individual accounts like cash or sales. After that, we prepare a trial balance. This is a crucial step to ensure that our debits and credits are balanced. which reflects the accuracy of our records. If necessary, we make adjusting entries. This ensures that everything is accounted for accurately before we proceed. Finally, we prepare the financial statements and close the accounts for the period. This wraps up our cycle, providing a clear view of our financial performance. These steps are foundational to understanding how accounting operates and play a vital role in the overall financial health of any organization. Now let's dive into financial statements. First, we have the income statement. This is crucial because it shows us whether the business is making a profit or incurring a loss. Essentially, it's all about the equation revenue minus expenses. Next up is a balance sheet. Think of this as a snapshot of the company's financial position at a specific point in time. It presents a clear picture of the company's assets, liabilities, and equity. Finally, we have the cash flow statement. This one is vital for understanding how cash moves in and out of the business. It tracks the liquidity of your company and helps ensure that you can meet your obligations. These three statements together give us a comprehensive view of a company's financial health and performance. Now now that we are covered the fa- sorry, now that we are covered the fundamentals of the accounting cycle, let's transition to applying that knowledge with some beginner friendly practice questions on principles of accounts. This is a great way to reinforce what we have learned and ensure everyone is on the same page. Remember, these questions will help you think critically about the concepts we have discussed. As we dive in, keep in mind that understanding these principles is essential for interpreting financial statements accurately. So let's have some fun with this. Make sure to think about what you have learned as we tackle these practice questions. Now let's dive into section 1, which focuses on multiple choice questions and their answers. These questions are designed to reinforce your understanding of financial statements and the principles underlying them. First, remember the key aspects we discussed earlier: the income statement, balance sheet, and cash flow statement. As we move into the questions, let's keep in mind how they relate to what you have learned. Let's dive into a fundamental concept in accounting, the accounting equation. So, what is the accounting equation? The correct answer here is B. Assets equal liabilities plus owner's equity. This equation is crucial because it establishes the foundation of the accounting framework. It shows that everything a business owns, which is assets, is financed either by borrowing money, which is liabilities, or through the owner's contributions, which is owner's equity. Understanding this equation helps us grasp how transactions affect the financial position of a business. Now, let's keep this equation in mind as we move on to the next question. It will further enhance your understanding of liabilities in accounting. Which of the following is an example of a liability? Here are your options: cash, accounts payable, equipment, revenue. The correct answer is B, accounts payable. This is a crucial concept in accounting as liabilities represent what a company owes to others. Remember, understanding liabilities is essential for assessing a company's financial health. Keep this in mind as we move forward into our next question, where we will explore how transaction affect accounts. Imagine a business that purchases office furniture on credit. This transaction impacts two important accounts. Can anyone guess which ones? The correct answer is B, office furniture and accounts payable. When the business acquires office furniture, it increases its assets, specifically the office furniture account. At the same time, it creates a liability which is reflected in accounts payable. This means that while the company gains an asset, it also has an obligation to pay for it later. This example encapsulates the fundamental balances in accounting. Every transaction has dual effects. Keep this duality in mind as we move forward. Which financial statement shows a company's profit or loss? We have several options here: balance sheet, cash flow statement, income statement, trial balance. The correct answer is C, income statement. The income statement is essential because it provides insights into a company's profitability over a specific period. It outlines revenues, costs, and ultimately whether the company made a profit or a loss. Now keep this in mind as we transition to our next question, which will further explore cash transactions in accounting. If a company receives cash from a customer for a previous sale, which account do you think is debited? The correct answer is cash. This this is an essential concept in accounting as it reinforces how we track incoming funds. So remember, when cash is received, we increase the cash account by debiting it. This is a fundamental aspect of our financial transactions. Next, we will delve into the two types of accounts affected in double entry bookkeeping. Section 2 is fill in the blanks. As we dive into double entry bookkeeping, let's focus on the core components involved. The two types of accounts that are crucial in this system are debit and credit. This framework ensures that every financial this framework ensures that every financial transaction is recorded in a balanced manner where total debits always equal total credits. Understanding these concepts is essential because they lay the foundation for accurate financial reporting. Now let's consider how these elements play a role in the overall financial statement, starting with revenue. So, revenue is recorded in the income statement. This statement is crucial for understanding a business's performance over a certain period. It reflects the earnings generated from core business activities, which can help us gauge overall profitability. Now, it's important to remember that this is just one piece of the financial puzzle. Next, we will explore all liabilities income into play. Sorry. Next, we will explore how liabilities come into play in the financial health of a business. The liabilities account is crucial because it shows what a business owes to others. So the blank spaces here is liabilities as you see. This includes loans, accounts payable, and any other financial obligations. Understanding liabilities help us grasp the financial health of a business. It's essential for both managers and investors to keep track of these obligations as they directly affecting cash flow and overall stability. Next, we'll discuss how purchasing an asset impacts the cash account. When a business purchases an asset, which cash no sorry when a business purchases an asset with cash, what happens? The cash account decreases. This is an important concept because it highlights how cash flow impacts overall financial health. Remember, every financial decision affects multiple accounts. Now, keep this in mind as you transition to our next topic, which will elaborate on how these transactions are documented in the ledger. Let's talk about the process of transferring transaction from the journal to the ledger. This crucial step is known as posting. As you see in the blank is posting. Posting ensures that all our transactions are accurately recorded and categorized, which is vital for maintaining clear financial records. Now, why is this process so significant? First, it helps us track our financial activities systematically. Second, it lays a foundation for creating financial statements that reflect the true state of our business. Remember, without effective posting, our financial data could become disorganized, leading to potential misinterpretations later on. Section 3 is short answer question and answers. Now let's dive into the distinction between assets and liabilities. Explain the difference between an asset and a liability with examples. First, an asset is anything the business owns that holds value. This could include items like cash, inventory, or equipment. Think of it as resources that can generate future economic benefits for the company. On the other hand, a liability represents money that the owes to others. Examples here would be loans or accounts payable. It's essentially the obligations that the business needs to settle in the future. Assets add value to the business while liabilities represent its debts. This balance is crucial for understanding a company's financial health. Next, we will explore the concept of a trial balance and its significance. What is a trial balance and why is it important? A trial balance is essentially a summary of all ledger balances. It serves a crucial purpose in accounting. It ensures that total debits equal total credits. This balance is vital because it helps us identify any errors before we prepare our financial statements. So, remember, a trial balance acts like a safety net, catching mistakes early on in the accounting process. The trial balance is not just a checklist, it's an essential tool for maintaining the integrity of our financial reports. Now let's dive into a practical examples of recording a transaction using double entry account. We have a scenario where a company pays $500 in rent. So, how do we record this? First, we will debit rent expense for $500. This is because our expenses are increasing, reflecting the cost associated with using the rented space. Next, we will credit cash for $500. This indicates that our cash asset is decreasing as we are using that cash to pay for the rent. We increase our expenses through the debit and we decrease our cash through the credit. This method ensures that our accounting records remain balanced, which is a fundamental principle of double entry accounting. Are there any questions about this recording process before we continue? Okay. Define owner's equity and explain how it changes over time. Let's dive into the concept of owner's equity. Owner's equity is essentially the owner's investment in the business. It's a crucial aspect of financial health. Now, it's important to remember that owner's equity isn't static. It changes over time. It increases with profits, meaning as your business earns, your equity grows. Additionally, any new capital contributions from the owner also boost this figure. Conversely, it decreases with losses and withdrawals. So, if the business incurs losses or if the owner takes money out, equity takes a hit. Understanding these dynamics is vital for managing your business effectively and ensuring long term success. Now, let's dive into the purpose of financial statements. First, we have the income statement. This is crucial as it shows a company's profitability over a specific period. Next, we have the balance sheet. This provides a snapshot of the financial position at a specific point in time, outlining what the company owns and owes. Then we look at the cash flow statement. This statement tracks the inflow and outflow of cash, giving insight into the company's liquidity. These financial statements are not just numbers on a page, they are essential tools that help businesses make informed financial decisions and attract potential investors. By understanding these documents, we can better navigate the financial landscape of a business. Now, let's dive into some practice questions designed to reinforce your understanding of the principles of accounts. These questions will vary in format, giving you a broad range of scenarios to think through. All right, section 1 is true or false. Now let's dive into some key concepts regarding the balance sheet and double entry accounting. The balance sheet shows the financial position of a business at a specific point in time. That is true. Okay, first, it's crucial to understanding that the balance sheet provides a snapshot of a business financial position at a specific moment. This is fundamental for stakeholders to assess the overall health of the business. Next, regarding double entry accounting, remember that every transactions aspect at least impacts at least two accounts. This ensures that the accounting equation remains balanced, which is essential for accurate financial reporting. Also, keep in mind that expenses do reduce owner's equity. When a business incurs expenses, it ultimately reduces the profit available to the owner, affecting their overall equity. Now, let's clarify some common misconceptions. Accounts payable is a liability, not an asset. And when the owner withdraws money, the cash account actually decreases, not increases. As we move forward to the next section, we will start exploring journal entry questions, continuing to build on this foundation. Section 2 is journal entry questions. Recording the following transaction using the double entry system. Now let's dive into how we record transactions using the double entry system. The double entry system is fundamental in accounting as it ensures that every transaction is recorded in a balanced manner. All right. These are some questions that to go into the journal. So let's see how we do it. Let's dive into the double entry system of accounting, which is crucial for maintaining accurate financial records. First, we see that the owner invested $5,000 in cash to start the business. This means we will debit the cash account and credit the capital account. This, trans- this transaction highlights the importance of understanding our owner investment impact our financial statements. Next, we have the purchase of equipment worth $1,200 on credit. This transaction shows us how acquiring assets can affect our liabilities. We debit the equipment and credit accounts payable, which indicates we owe money for this purchase. Then we see the payment of $800 in the cash for rent. Here we are reducing our cash and recognizing rent expense. This reflects the operational cost that every business must manage. Finally, we have received $2,000 from a customer for services provided, which increases our cash and recognizes revenue. And we also paid $500 to our supplier for our goods previously purchased on credit, reducing our cash and accounts payable. Each of these transactions is vital for understanding the flow of money in and out of the business. It's the foundation for our financial health. Section 3, calculation questions. So these are some calculation questions. Let's look at the owner's equity calculation using the accounting equation. We have the total assets of the company at $50,000 and liabilities of $20,000. Now, using their formula, assets equal liabilities plus owner's equity, we can rearrange it to find owner's equity. So if we plug the numbers in, $50,000 equal 20,000 plus owner's equity. To find owner's equity, we simply subtract liabilities from assets. After doing the math, we find that owner's equity is $30,000. This figure is crucial as it represents the owner's share of the business after all liabilities have been settled. Next, we will tackle the net profit calculation. Are there any questions about this slide before we move on? Now let's look at calculating net profit. We have revenues of $15,000 and expenses of $9,000. The formula we use is simple. Revenue minus expenses give us the net profit. So calculating this gives us $15,000 minus $9,000, which equals $6,000. This means the company made a profit of $6,000. Understanding this concept is crucial for assessing a company's financial health. Let's keep this in mind as we move to our next calculation. Now let's move on to calculating the closing cash balance, which is fundamental to understanding cash flow management. We started with an opening cash balance of $5,000. First, we add the $2,500 we received from a customer. This enhances our cash position. Next, we need to consider the expenses. We paid $1,200, which reduces our cash. Additionally, the owner withdrew $800. That's another deduction from our cash. So, putting this all together, our closing cash balance stands at $5,500. This calculation not only reflects our cash inflows and outflows, but is crucial for maintaining a healthy cash flow. Section 4, matching questions. As we move into our matching questions, let's take a moment to reflect on what we have just covered regarding cash balances. Now, I want you to consider the different types of accounts we often encounter in accounting. First, we have expenses. These are costs incurred in the process of earning revenue, like rent or utilities. Next, think about assets. These are valuable resources owned by a company, such as equipment or accounts receivable. Lastly, we have liabilities. These represent obligation or debts like a bank loan that needs to be repaid. Remember, matching these account types with their correct categories is crucial for understanding financial statements and overall accounting principles. Let's see how well you can identify these account types. Take a moment to think about the options presented as we dive into the matching exercise. Let's take a moment to explore how different account types align with their respective categories. First, we have accounts receivable, which falls under assets. This represents the money owed to us by our customers. Next is rent expense, categorized as an expense. This is an outgoing cost that impacts our financial performance. Then we have sales revenue classified as revenue. This is the income generated from our primary business operations. On the liability side, we have bank loan, which is categorized as a liability. This indicates our obligation to repay borrowed funds. Lastly, we have equipment, which is also classified as an asset. This represents the tangible resources we use to generate revenue. These matches are foundational to understanding how each account type interacts within our financial statements. Next, we'll delve into some practice questions to further strengthen your understanding of these principles. Here are more practice questions and answers to strengthen your understanding of principles of accounts. Section 1, multiple choice questions and answers. Now let's dive into our specific practice questions related to loans. This question is, which account is affected when a business takes a loan from the bank? We have four options to consider. Option A states that cash increases and bank loan increases. Option B suggests cash decreases and sales revenue increases. Option C says accounts payable increases and owner's equity decreases. Lastly, option D claims cash increases and drawings increases. The correct answer is A, cash increases and bank loan increases. This is a foundational concept in accounting showing how liabilities and assets interact when obtaining a loan. Understanding these principles will strengthen your grasp on how transactions affect financial statements. Next, we will explore the purpose of a trial balance. What is the main purpose of a trial balance? The trial balance serves a crucial role in accounting. Its main purpose is to check if total debits and credits are equal. This balance is essential because it helps ensure the accuracy of the financial statements. If the numbers don't match, we know there's an issue that needs addressing. So remember, the key takeaway here is that the trial balance is a vital tool for maintaining the integrity of financial records. Next, we'll explore what happens if the trial balance doesn't balance. What could be the reasons behind it? If the trial balance don't have balance, what could be a possible reason? We have a few possibilities to consider. First, one common reason is that a transaction was recorded twice. This can easily throw off our figures. Secondly, it's also possible that a transaction was completely omitted. Imagine missing a key entry that can create significant discrepancies. Lastly, we might find that a debit entry was mistakenly recorded as a credit entry. This error can lead to confusion and misinterpretation of our financial standing. So the answer here is D, all of the above. Understanding these potential errors help us maintain accurate financial records, which is essential for any business's success. If a business pays wages to employees, which accounts are affected? The correct answer here is that wages expense increases while cash decreases. This is a crucial point because it highlights how expenses directly affect the cash flow of a business. When a company incurs wages, it reflects an outflow of cash, thus reducing its overall cash balance. Understanding this relationship is essential for managing a company's finances effectively. Next, we'll explore another important concept: prepaid rent. Now, let's explore the nature of prepaid rent. Prepaid rent is classified as an asset. Why is that? Because when a business pays rent in advance, it eventually secures the right to use that property in the future. This is a valuable resource for the company. So remember, understanding the classification of prepaid rent helps in recognizing how it impacts the financial statements. Now, let's move on to the next section where we'll dive into journal entry questions. Section 2, Journal Entry Questions and Answers. Record the journal entries for the following transactions. And these are the questions to go into the journal. And how it is done. Let's dive into our transaction from the last slide. First, we have the owner investing $10,000 in cash. This is recorded as a debit to cash and a credit to capital. Next, we purchase inventory worth $3,000 on credit. Here we debit inventory and credit accounts payable. Moving on, we pay $2,000 in salaries, which is a debit to salaries expense and a credit to cash. This is essential for reflecting our operational costs. Then we receive $4,000 in cash from a customer for services provided. This increases our cash account, so we debit cash and credit revenue. Lastly, we paid $1,500 for office rent, debiting rent expense and crediting cash. This is crucial as it shows our ongoing expenses. Now, keep these entries in mind as we prepare to discuss any errors in our accounting practices. Section 3, identifying the errors. There are some incorrect accounting entries. Identify the mistake and correct them. Let's take a closer look at the first error in our entries. We purchased equipment worth $2,000, but instead of recording it correctly, we mistakenly debited sales revenue and credited cash. This is not just a minor oversight, it completely misrepresents our financial position. To fix this, we need to debit equipment for $2,000, which accurately reflects the asset we have acquired. Credit cash for $2,000, showing that this amount was paid out. Correct accounting ensures transparency and helps us make informed business decisions. Let's remember to always double check our entries to avoid such mistakes. Now let's move on to the next error involving our electricity bill. Now let's move on to our second incorrect entry. We have the case of an electricity bill that was paid for $500, but it was mistakenly recorded as debit utilities payable $500, credit cash $500. This is an important distinction because it affects how we represent our expenses. The correct entry should actually be debit utilities expenses and $500 and credit cash $500. This correction ensures that our expenses are accurately reflected in our financial statements. Remember, accurate accounting is crucial for understanding our financial position. Next, we'll tackle the owner's withdrawal, which was recorded incorrectly as a salary expense. Now, let's discuss the third correction involving the owner's withdrawal of cash. We initially recorded this transaction incorrectly as debit salary expense, credit cash $800. This is not this is not accurate because the cash withdrawn was for personal use, not a salary expense. The correct journal entry should be debit drawings $800 and credit cash $800. This 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 distinction is crucial as it impacts the equity of the business. Remember, drawings reduce the owner's equity while salary expenses affect the operational cost. Next, we'll transition into our short answer questions where we'll dive deeper into concepts like accrued expenses and prepaid expenses. Section 4, short answer question and answer. Let's explore the difference between accrued expenses and prepaid expenses. First, accrued expense are expenses that have been incurred but not yet paid. A common example is unpaid salaries. Think of it as the costs that are recognized during a period but haven't been settled in cash yet. On the other hand, we have prepaid expenses. These are payments made in advance for future expenses. A typical example would be prepaid rent, where we pay for the use of a space before we actually occupy it. Accrued expenses recognized now, paid later. Prepaid expenses paid now, recognized later. These distinctions are crucial for accurate financial reporting as they help businesses track their liabilities and assets effectively. Let's dive into the purpose of financial statements, which are crucial for understanding a company's performance and position. Explain the purpose of the income statement and the balance sheet. First, we have the income statement. This statement provides a snapshot of the company's profit or loss over a specific period. It's where we see how well the business is doing financially, highlighting revenues and expenses. Next, we turn to the balance sheet. This document represents the financial position of the company at a specific date. It follows the fundamental equation assets equal liabilities plus owner's equity. This equation is vital because it helps us understand what the company owns versus what it owes. The income statement tells us about profitability over time, while the balance sheet provides a snapshot of financial health at a point in time. Now, let's move on to the next topic regarding depreciation in accounting. Now, let's dive into the topic of depreciation in accounting. Depreciation. Why is depreciation recorded in accounting? Depreciation is crucial because it helps us allocate the cost of fixed assets over their useful life. Think of it as a way to spread out the expense associated with an asset, like a piece of machinery or a building, over the time we expect to use it. This not only reflects the wear and tear that occurs, but also provides a more accurate picture of our financial health. By recording depreciation, we ensure that our financial statements present a true value of our assets, which can impact decision making and investment. So, when you think about it, depreciation isn't just a number on a spreadsheet, it plays a vital role in how we manage and access our resources. Let's keep this in mind as we move on to the next topic, capital versus revenue expenditure. Now let's dive into the difference between capital expenditure and revenue expenditure. First, capital expenditure refers to money spent on acquiring fixed assets. This includes significant purchases like a building or machinery that will benefit the company over a long period. In contrast, revenue expenditure relates to the day-to-day operation of the business, such as rent and salaries. These are essential for running the company but don't contribute to long term asset growth. Capital expenditure are investment in the future. Revenue expenditure are necessary for the present operations. Understanding these differences is key to managing finances effectively. Let's delve into contra accounts, a key concept in accounting. Define contra accounts and give two examples. Contra accounts are vital because they reduce the value of related accounts. This helps us get a clearer picture of our financial health. Now let's look at two common examples. First, we have accumulated depreciation. This account reduces the value of fixed assets over time, reflecting their wear and tear. Second, there's sales returns and allowances. This account decreases total sales, acknowledging that not all sales are final and some products may be returned. Understanding these accounts allows us to maintain accuracy in our financial statements. that's the end of this segment of principles of accounts and I hope you have learned a lot in this accounting process. So you can go back and look at it and study and practice. Don't forget to like, share, and subscribe. Thank you for watching.